The Federal Housing Finance Agency published research that establishes the precise mechanism of the current housing crisis. For every single percentage point that current market rates exceed a homeowner's locked-in mortgage rate, the probability of that home being sold drops by 18.1%. That is not a projection. That is a documented behavioral measurement from a federal agency. Now apply that number to the current environment. The average rate on all outstanding U.S. mortgages stood at 4.4% as of Q4 2025, according to housing economists. Freddie Mac recorded the average 30-year fixed mortgage rate at 6.22% as of mid-March 2026. That gap between what existing homeowners pay and what new buyers must pay runs between 2 and 4 percentage points for the vast majority of American homeowners. Apply the FHFA's 18.1% drop in sale probability per percentage point. You get a collapse in willingness to sell of 36% to 72% across the locked-in homeowner population. The FHFA's same research confirmed that the lock-in effect directly caused a 57% reduction in home sales among fixed-rate mortgage holders in Q4 2023. It prevented an estimated 1.33 million home sale transactions between Q2 2022 and the end of 2023. 1.33 million sales that never happened, 1.33 million families that never moved, 1.33 million properties that never hit the market. And the structural conditions that created that freeze have not changed as of early 2026. To understand how the trap was built, you need the full timeline. In spring 2020, the Federal Reserve slashed the federal funds rate to near zero in response to the pandemic. By late 2020 and through most of 2021, the average 30-year fixed mortgage rate fell to levels no living generation of homebuyers had ever seen. Rates dipped below 3%. Millions of Americans locked in mortgages at 2.65%, 2.5%, and 2.8%. A $350,000 mortgage at 2.8% produces a monthly principal and interest payment of approximately $1,140. Those rates were not just low by historical standards. They were anomalies, produced by emergency policy that was never designed to be permanent. Beginning in March 2022, the Federal Reserve launched the most aggressive rate hiking cycle in more than 40 years. Between March 2022 and July 2023, the Fed raised the federal funds rate 11 consecutive times. It moved from near zero to a range of 5.25% to 5.5%. The average 30-year fixed mortgage, which had been below 3% just a year earlier, surged past 4%, then 5%, then 6%, then 7%. By October 2023, it briefly touched 7.79%, the highest level in 23 years, per Freddie Mac data. Now consider the same $350,000 home. According to the S&P Core Logic Case-Shiller Home Price Index, American home prices rose approximately 30% between early 2020 and late 2024. They're up roughly 16% since the beginning of 2022, even as rates surged. That same home is now worth between $400,000 and $450,000. To purchase it at Freddie Mac's recorded rate of 6.22%, the monthly payment is between $2,300 and $2,500. That is more than $1,000 per month more than the locked-in payment, $12,000 more per year, $300,000 more over the life of a 30-year mortgage. The question, whether a homeowner paying $1,440 per month would voluntarily move to pay $2,500 per month, has a documented answer. Bankrate's 2025 Mortgage Sentiment Survey found that more than 54% of American homeowners surveyed said there is no mortgage rate at which they would feel comfortable selling their home this year. Not 6%, not 5%, not even 4.5% was sufficient to break the lock. Wolf Street's analysis confirmed that, as of 2025, the share of adjustable rate mortgages outstanding has remained at approximately 4%, down from over 10% in 2013. The overwhelming majority of homeowners are locked into fixed rates with no automatic reset mechanism. Their rate stays where it is until they sell or refinance. They are choosing to do neither. The Federal Reserve Bank's own research confirmed that the lock-in effect explained 44% of the total drop in homeowner mobility between 2021 and 2022. Nearly half the reason people stopped moving had nothing to do with jobs, family circumstances, or economic stress. It was purely the financial mathematics of not trading a 3% rate for a 7% rate. The same Federal Reserve Bank research, published in 2025, found that the 2022 lock-in shock reduced time on market by 29% and drove home prices approximately 8% above where they would otherwise have been. The lock-in effect did not just freeze supply, it directly inflated the prices that buyers were forced to pay. The price and affordability data confirms the human cost of that freeze. As of early 2026, American home prices are up approximately 35% compared to early 2021, and they have barely moved in either direction over the past 18 months. The National Association of Home Builders calculated in early 2026 that Americans need to earn approximately $141,000 per year to afford the median-priced home. The average U.S. salary is approximately $87,000, according to Bureau of Labor Statistics data. The typical American household earns roughly 40% less than what is required to buy the median home. The Atlanta Federal Reserve's Housing Ownership Affordability Monitor confirmed that as of mid-2025, owning a median-priced home consumes 47.7% of the median household's income. That figure has hovered between 40% and 50% for 2 consecutive years. The traditional affordability threshold used by housing economists is 30%. The market is running nearly 18 percentage points above that threshold, and has been for 2 years. The National Association of Realtors confirmed in its research that there is currently a 4.7 million unit housing shortage nationwide. Active listings stood at approximately 1.1 million as of late 2025, according to Realtor.com. The highest level seen in that month since 2019, but still roughly 21% below the pre-pandemic norm of approximately 1.4 million listings that was already considered supply constrained. The reason inventory is not recovering faster, despite 3 consecutive years of modest gains, is the lock-in effect itself. The human consequence of these structural conditions was confirmed by the National Association of Realtors in November 2025. For the first time in the recorded history of American real estate, the median age of a first-time homebuyer in the United States has hit 40 years old. In 1991, that median age was 28. By 2020, it had risen to 33. By 2022, it climbed to 36. By 2024, it reached 38. By 2025, the NAR confirmed it had reached 40, a full 12 years older than it was in 1991. The NAR's 2025 profile of homebuyers and sellers confirmed that first-time buyers now represent only 21% of all home purchases. That is a collapse of approximately 50% compared to their market share in 2007. NAR research confirmed that delayed home ownership from age 30 to age 40 costs the typical buyer approximately $150,000 in lost equity accumulation on a typical starter home, $150,000 in wealth that an entire generation is not building because the market will not let them in. The Federal Reserve's Survey of Consumer Finances established that the average homeowner's net worth is 43 times that of a renter. The longer a generation spends locked out of the ownership market, the wider that wealth gap becomes. Home ownership rates for millennials at age 30 stand at 33%, according to Apartment List's 2025 report. That compares to 42% for Gen X at the same age and 48% for baby boomers. The generation currently in its peak family formation years is entering home ownership at a rate 15 percentage points below what boomers achieved at the same life stage. Harvard University's Joint Center for Housing Studies in its 2025 State of the Nation's Housing Report confirmed that cost-burdened renters, those spending 30% or more of income on housing, cannot save the down payments needed to exit the rental market. They are trapped renting because they cannot accumulate enough to buy, while existing homeowners are trapped in place because selling would cost them far too much in higher monthly payments. 2 separate groups of financially imprisoned Americans, held in place by the same structural force from opposite sides. Running parallel to the mortgage rate lock-in is a second, less discussed trap, the capital gains tax lock-in. The capital gains tax exemption for homeowners was established in 1997. Under current law, a single filer can exclude up to $250,000 in gains from the sale of a primary residence. Those thresholds have never been updated for inflation. According to FHFA data, the average home price in the Northeast United States rose from approximately $231 to $400 in 1997 to over $170,000 in Q2 2025. That is a capital gain of approximately $939,000 on an average priced Northeast home. For a married couple, the $500,000 exemption covers barely more than half of the taxable gain on an average home in that region. Any older homeowner who bought in that region decades ago faces a tax bill that could easily exceed $150,000 to $200,000, on top of real estate commissions, legal fees, and moving costs. The psychological impact is direct. The baby boomers who own enormous 4-bedroom houses that younger families need to purchase are sitting on those properties because selling would trigger a tax event so large it eliminates much of the financial benefit of moving. Redfin's analysis found that baby boomers own approximately 28% of all 3-bedroom plus homes in the United States. A 2024 Redfin survey found that nearly 80% of boomers over 60 own their home. Over half of those homeowners carry no mortgage at all. 71% plan to age in place indefinitely. 28% of the entire 3-bedroom plus housing stock in America sits in the hands of a generation that has explicitly told researchers it is not moving. The home building sector has responded to the supply freeze with a measurable structural shift. Recognizing they cannot compete with existing home inventory, because there is virtually none, builders have been offering mortgage rate buydowns of 100 to 200 basis points below prevailing market rates. JP Morgan analysts confirmed this in their January 2026 housing outlook. According to NHB data published in mid-March 2026, 64% of homebuilders are currently offering sales incentives and 37% have resorted to direct price cuts to move inventory. The result is a complete inversion of the historical norm. Realtor.com's Q4 2025 data showed the median new home is now $56,228 cheaper than an equivalent existing home. New construction has historically commanded a premium over resale. That premium has reversed. The inversion is reshaping buyer behavior towards Sunbelt and Mountain West markets, Phoenix, Dallas, Nashville, Jacksonville, Raleigh, where builders have land and competitive pricing. It is simultaneously leaving Northeast and Midwest cities even more supply-starved, where land is constrained and permitting processes are significantly slower. Every major institutional forecaster is projecting the same essential outcome through 2028. Rates stay elevated, prices stay flat. Fannie Mae's Economic and Strategic Research Group published in its February 2026 housing forecast that 30 to 1-year fixed rates will average 6.1% in Q1 2026. The Mortgage Bankers Association predicted 30-year rates will hold at 6.1% through most of 2026, 2027, and 2028. Redfin projects 30-year fixed rates will average 6.3% for the full year 2026. Realtor.com. Chief economist Danielle Hale gives essentially the same projection. Morgan Stanley projected rates could fall to approximately 5.75% by mid-2026 if the 10-year Treasury yield declines as expected, then rise again in the second half of 2026 and into 2027. Wells Fargo's economic group forecasts 30-year fixed rates averaging 6.14% in 2026 and 6.19% in 2027. JP Morgan's housing research summarized the consequence directly in its January 2026 outlook. Home prices are expected to stall at 0% nationally in 2026. Not crash, not recover dramatically. Stall. A 0% price growth forecast alongside 6% plus rates and frozen supply describes a market that is neither correcting downward nor recovering upward. It is locked. Fannie Mae's 2025 research confirmed that even the temporary dips to approximately 6% seen in September 2024 produced almost no increase in mortgage applications or home sales volume. The NAR confirmed that a sustained move into the mid-5% range or below would be necessary before meaningful seller unlock occurs. That sustained mid-5% rate is not what any credible forecaster is projecting for at least the next 18 to 24 months. 3 specific data-grounded actions follow from this structural picture. The first is for current homeowners on sub-4% mortgages. That locked-in rate is a documented financial asset, one that appreciates in value every day that market rates remain above 6%. The FHFA research established this precisely. Do not sell unless the life circumstances demanding it are genuinely non-negotiable. If a sale is unavoidable, relocation, divorce, estate settlement, model the full monthly budget restructuring that results from giving up that rate before listing. The financial step change from a $1,440 payment to a $2,500 payment requires explicit planning, not an assumption it will work out. The second is for buyers navigating the frozen existing home market. The institutional consensus is unified. Prices are not going to fall 30% or 40% and create a buying opportunity that offsets elevated rates. JP Morgan calls for 0% price growth nationally. Morgan Stanley calls for modest appreciation. The scenario where waiting produces a dramatically cheaper entry point is not in any serious institutional forecast. What is available now is builder competition. The $56,328 discount on new construction relative to existing homes, confirmed by Realtor.com Q4 2025 data, combined with builder rate buydowns of 100 to 200 basis points, represents the most genuine buyer leverage in the housing market since the pandemic. Sunbelt metros with recovered inventory are where that leverage is most accessible. The third is the longer-term structural context. The 4.7 million unit housing shortage confirmed by NAR will not close quickly. The capital gains tax thresholds established in 1997 have not been updated. The boomer age-in-place decision confirmed by Redfin's 2024 survey data will not reverse on a short timeline. The lock-in effect will loosen gradually as the share of mortgages above 6% grows. Realtor.com confirmed that share crossed the share of sub-3% loans for the first time in Q3 2025. But gradually is the operative word. The Federal Reserve Bank's own research found the lock-in shock explained 44% of the drop in homeowner mobility in 2021-2022. That is not a problem that resolves in one rate cycle. It resolves over years, not months. And in the meantime, the median first-time homebuyer in America is 40 years old, according to the NAR, 12 years older than in 1991, losing an estimated $150,000 in equity accumulation compared to what buying at age 30 would have produced, building wealth 43 times more slowly than the average homeowner, according to the Federal Reserve's own data. That is the documented structural cost of a market locked between two traps: the owners who cannot afford to sell and the buyers who cannot afford to buy.